All right, good afternoon, everyone. Welcome. My guess is we'll have some more folks joining over the next minute or two. I know sometimes Zoom can be a bit congested, but have a great opportunity for all of us to learn from really three practitioners in the Opportunity Zone space today. And I want to make sure that we use as much of that opportunity as we can. Just for everyone who doesn't know me, I'm Adam Northup. I'm the Executive Director of Opportunity Virginia, which is a not quite year and a half old venture that is building out a healthy Opportunity Zone marketplace for the Commonwealth of Virginia, focused really on making the capital flow to every Opportunity Zone and every type of project is sort of our unstated but very important goal. And we work both sides of the capital equation. You know, we spend a lot of time helping elevate projects and working in the capital stack of those projects, seeing that the Opportunity Zone incentive will work. And we also spend time working with investors, helping them find opportunities in Virginia and evaluate those. And hopefully, by doing both of that work, we've found that there's some matchmaking there and deals get done. The three folks that I'm going to let introduce themselves in a minute have shown up in that work that we're doing, and I think have been doing some pretty amazing and unique work in this particular space. So stay tuned for a little bit more on that. I won't do any more advertising about us, but I do want to both set the objective and set the agenda for the call. The objective is simply this, which is the Opportunity Zone tax incentive, as stated, is intended, is meant to create jobs and economic growth and prosperity in low-income communities. And a very stated objective of the incentive was the creation of jobs through capitalizing opportunity or operating businesses. We all know the program has been well suited for real estate investment, somewhat just by the nature of the design of the long-term investing window and some other things. What we've discovered over the past year after things got in place is the operating businesses are starting to figure it out as well. And we have some unique examples to explore today. And that's really what we wanted to spend some time on with all of you, is just giving you some insights into what that could look like, and also giving this group a somewhat limited chance to ask some questions on that front too. I will, in terms of the actual agenda and sort of technically how this will work, we will keep it to an hour. I know everyone is busy, but I also know that I can speak for myself maybe. There is such a thing as Zoom fatigue, and I find that an hour is about all I can put into it these days, and I'm sure that's true for many of you. So we'll keep it lively and dynamic and hopefully informal in order to make it engaging conversation. It'll be a fairly simple setup. I'll let folks introduce themselves, and then I'll ask a few questions to get us started. And then we will definitely open it up for Q&A. We'll probably stop Q&A and do another couple questions if they don't come up in the Q&A, and then, or I'll ask another couple questions and then we'll bring it back to Q&A. So there'll be ample opportunity to ask some questions. The way that the question asking will actually work, because we have potentially 100 people on this Zoom workshop, is we ask that you type your questions into the Q&A button that should be on the bottom of your Zoom tab. And Valerie Lee, who you can see on the screen, who is the Director of Marketing for Opportunity Virginia, is going to help me sort through those and find the big themes. And then I'll moderate asking some of those questions to our panelists as well. So please make sure to type those in, because again, there isn't going to be an opportunity to verbally ask them. There is a chat function, which you're welcome to use. It's generally good for sharing additional insights or offering to help others out or pointing to other resources, those types of things. We will not be monitoring that for questions though. So just to be clear, please use the Q&A box for the questions and chat for any other dialogue. We will monitor that too, but probably not in the vein of sourcing out questions. Before I get going, because I know that took 3 or 4 minutes already, Valerie, anything I missed kind of from a agenda or technology standpoint I should share?
The only thing that I'll share is that we are recording today's webinar, and we'll be sending out a follow-up email to everyone who registered with a link to that recording. That's it.
Fantastic. Well, let me make this much more interesting, and I'm gonna let each of the panelists introduce themselves and include a little bit of a description of your business and how opportunity and how the Opportunity Zone incentive has come into play. I would also ask, share a little bit about how you even learned about the incentive in the first place and kind of how you got yourself educated about it and got going, because I would share, I would posit that a lot of folks on this call, that's the #1 problem for them is just figuring out how to even get started with the program. Jay, why don't you start, since the way my screen is working, you're next to me.
My name is Jay Bockhaus. I'm the managing partner of the CORI Innovation Fund, which is under the umbrella of an organization called the Center on Rural Innovation, which seeks to close the opportunity gap that developed over the last decade or so between economic opportunity in rural America and metro areas. We have a network of smaller community tech hubs that we link together, and the idea is to foster the growth of startup businesses and remote working in those smaller communities. We specifically started the seed fund, which I manage, at the end of last year, and all of our 20 communities in our network are either in or contiguous with opportunity zones. We launched the fund to invest in tech-enabled businesses, either coming out of the network or others who are located in smaller community opportunity zones across the United States. I will pass it to Karen because she's next to me.
Well, good afternoon or good morning. I guess it's good afternoon for most everyone. I'm Karen Sorber. I'm the CEO of Micronic Technologies. We are a early stage disruptive water treatment technology company. And we're about to commercialize our technology in the next year to 2 years. We have extraordinary traction with EPA on evaluating our technology, as well as our first customer. This treatment device is very disruptive, patented, and scary to a lot of people. We had a difficult time getting investor interest. We used to be up in Washington, D.C. area, and they typically don't invest in deep technology like ours. It's a major industrial device. So we moved to Southwest Virginia for grant opportunities. I learned about the Opportunity Zone a couple of years ago in a meeting where someone had mentioned that if you're thinking about moving your facility, you might want to consider moving it into an Opportunity Zone. And that's what we did. We were in Wise, Virginia. We're now in Bristol, Virginia, in Washington County. And we have landed in an Opportunity Zone. And we have now had success in attracting funding from institutional investors around that.
Rich?
Okay, my name is Rich Larochelle. I'm here because I'm director of the Fredericksburg Food Co-op. I'm the current chairman of the board. We're a startup community-owned grocery store in Fredericksburg in an opportunity zone. And we incorporated in 2015. We built our co-op membership, our ownership, to over 1,600 households. And the co-op is built around 4 key principles. Buying from local farmers as much as possible. So we help to support local agriculture. Number two, centering environmental sustainability in everything we do. And third, being an inclusive community around the link between food and health and having affordable, healthy food for people in our community. And then operating a financially successful grocery store. So to get this done, we had to not only build our membership, we needed to raise $4.3 million. Most of that came from loans, 15-year loans made by our co-op owners to the co-op, subordinated to bank debt. We also got a $1.4 million bank loan, but we still needed a chunk of money. And our Director of Economic Development, Bill Freeling, and his staffer, Angela, suggested the Opportunity Zone Fund mechanism. So we created our own Opportunity Zone Fund, and we raised a chunk of money by doing that. So we'll be opening our grocery store on on Jefferson Davis Highway in Fredericksburg in January. So I want you all to come by and visit us and buy a lot of healthy local foods.
Just one more note to add. We have a good relationship with the EDA, Economic Development Administration, and they were instrumental in steering us towards the Opportunity Zone program as part of the fund.
Thanks, Jay. Thanks, Karen. Thanks, Rich. Rich, I'm actually going to stick with you, and the point I make before I'll ask the question is something you were just touching on, which is, I think a lot of businesses who look at the Opportunity Zone incentive assume that you need to approach a fund, something similar to what Jay operates, which is a multi-investor capital pool that then decides what they want to invest in. But in your case, and this is somewhat unique in our experience, you actually set up your own fund, which is actually what the law calls it, in order to raise that capital yourself. Can you talk a little bit about that process and what were the challenges, what worked well, who needed to help, how much legal help did you need, how much accounting help did you need, et cetera, to give folks a flavor for if they went that route, what would that look like?
Sure. Okay. So first of all, kind of why we decided to go this route. Our value proposition is probably a lot different than that offered by a lot of Opportunity Zone funds, which might be a very substantial return potential. In our case, investors in our fund purchase units in the fund, and the fund uses those monies to buy preferred stock issued by the co-op that has a 6% dividend. So that's the return that an investor will get, in addition to the tax benefits associated with the OZ funds. So we really needed to reach investors who our value proposition was basically, you can earn a fair return while doing something really great for this community. And so those are the investors we're really targeted toward. So we had a law firm that we've worked with a lot that does a lot of food co-op and other co-op work, Dorsey Whitney. They don't do OZ funds, but they connected us, or they don't specialize in that. They connected us with a law firm that has created Opportunity Zone funds, and we worked with them, and we over a period of a couple, 2-3 months, developed the offering documents. They also connected us with an accounting firm that specializes in this, that is handling all of the reporting for us. And then we connected with Opportunity Virginia. We connected with Jay Beekman. He did a great job for us. He came up to Fredericksburg on a number of occasions. We had meetings with people in our community, he did part of the presentation. I did part of the presentation. We answered all the questions, and that combination of putting together the legal documents, handling the financial aspects well, working with Opportunity Virginia to give assurances to everyone that exactly how this worked. They could investors could look at their own situation and determine is this something I'm interested in? And all of that resonated. And thanks to the Opportunity Zone Fund and the help from Opportunity Virginia and others, we're able to come up with the money we need. And so we're right on the edge of opening. So it's an exciting time for us where the construction, the build out of our store is going on right now. We have an awesome general manager that we've hired. He'll be hiring 35 to 40 people. So we'll be creating good local jobs. And there's been a lot of interest in the jobs here. So it's an exciting time for our community because we're, a community-owned grocery store, and the Opportunity Zone mechanism really fit into what we're trying to do extremely well. I hope that answers most of the question. I could go on for a long time, but I'll stop there.
Rich, that's great. There's another thread in there that I'm going to pull in a couple questions, but I want to return to Karen because, like you, Karen's figured out how to work the Opportunity Zone incentive in a way that thus far isn't, something we're seeing writ large, which is funding an existing business. I think most folks think that the way this would work is you'd have to start a business in order to get this type of equity capital. But in fact, you can use this equity capital to, fund an existing business or even relocate a business, et cetera. Karen, can you do something similar to what Rich said? Can you kind of walk through what you did and how you did it and the pitfalls? What would help folks who have a business today kind of get going if this is a path they wanted to take?
Absolutely. First of all, I didn't know anything about opportunity zones. I had not read the legislation and I'd only heard a little bit about it. I just knew how the map worked and how I was going to pick the place on the map to go to move my business to. And so then I started seeking out people who might know more about it. And I came to visit Adam, and he was gracious enough to give me some time. And that's percolated my interest, and he told me that things would be happening in the future and for keep my eyes open, etc. And then Opportunity Virginia offered me an opportunity to speak at their launch about a year ago, and I did do that, created a little bit of a stir, and Jay Beekman was helpful and his staff were helpful to get me into their ecosystem, and I'm on their website, and so people can go and look and see that there's an operating business that they can invest in. And so I became somewhat legitimate, right? Because I was out there and on your website. And then over time, Jay had introduced me to Jay Bockhaus, who's on the panel here. And I went through due diligence with him. And it was just like a regular investor due diligence scenario. He gave me the list of documents. We opened up a data room. He did his evaluation. And I now have him targeted for my Series A round. I was able to settle Series Seed with the Pearl Fund, who Jay Beekman also referred us to. And then he would check in with me, call me every few weeks to make sure everything was going okay. Is there anything else he could do, etc. So I had resources to ask questions of. And when I started into the Pearl Fund, in terms of their investor process, there were times I called Jay to get his advice on something because I didn't understand it. He would give me his advice. So it's a fairly small ecosystem, and you need to get into it. If you're a business or you're an advisor to a business who wants to do this, you need to get inside the ecosystem, get known, network, do your Zoom calls, what have you, and get out there so that you can learn as much as you can. And so what I did is I pulled down whoever the accounting firm or law firm that was pitching it to people, I pulled down their PowerPoints, etc., and learned as much as I could. But there was nothing that I could have learned in advance that would have prepared me for what I went through. It was a lot. And I think our situation is a little bit unique. And I think took much more diligence, a lot more difficult, and very much more expensive than it would be for some businesses. And I'll tell you why. If you are going to, even if you're an existing business and you're going to move into an opportunity zone, or you're going to already are in one, all of your assets have to be qualified assets. And if they're old assets, they don't qualify. If they're before 2018 or December of 17, they don't qualify. and you have to have 70% of your assets in as good assets. So I went through all this process with a consultant, a very good consultant, who helped us understand the present value, the current value of our assets, the depreciated value, what the real numbers were on the books, and then what we would have to do in order to turn that into a 70% qualification rule. So that means we have to buy new equipment, which is fine. We got investor money for that. Plus we had a lot of equipment planned for grants that we are currently executing. And so we have capital going to be purchased for that. But it made it much more difficult because it was a little riskier because we didn't qualify on its face. We have to qualify within a 31-month period of safe harbor in order to certify that we are QOZB with that asset piece. Now, at the beginning of the process, I had to I had to give a rep letter saying that we've got the plan, that we will have it done, we will certify, and we are going to comply with it. And that letter was a little scary, but I've got a great CFO now, and we're on the road to making sure that's not going to be an issue. So there's a whole lot more to the story, but that's the one having to do with what I think was unique to us in that most of and we have milling machines, bridge ports, all kinds of welders and all this equipment that didn't qualify. And most people that won't be the case if they start a business or if they're an existing business and they've just recently bought their plant equipment or plan to buy plant equipment with this investment. Does that make sense? Did you pick up what I was putting down?
Thank you, Karen. I think, what you heard as a theme, everyone in there, which is something that's important, is you can learn a lot and figure out a lot by yourself. But we found, and I know that those two have found, that it is important to get guidance and counsel, as these are equity transactions at the end of the day. And you want to be comfortable with what you're offering potential investors and likewise. And so it is important to really add that at the outset to the list of to-dos as you embark here. Jay, I want to turn to you. We've heard two examples now of a way to use the Opportunity Zone incentive for an operating business. You have a much broader landscape. You get to look at quite a bit. I'd be curious, what does that landscape look like for you? How much has it been startups versus businesses trying to capitalize themselves or a move? And what are the trends that you're seeing, just sort of in general, about what's working in the operating business space of Opportunity Zones? Just so folks on the call can get a flavor for where they may be able to find some best practices and other examples.
Yeah, so as you mentioned at the outset, the vast majority of qualified opportunity funds focus on real estate transactions. I think the path for real estate was much clearer early in the legislative process. There's been guidance issued since then that makes the operating business piece much more clear. We've done 5 transactions so far this year. 3 of those companies were already located within an opportunity zone. 2 of them decided to relocate to be part of the portfolio. So it can work both ways. I would say it tends to be easier for the businesses that we are investigating because they tend to be earlier stage technology startups, which means one, they don't have as long a life as some other companies, meaning a lot of them were founded the bulk of their operations post 2017. And the ones that are older tend to have more limited tangible asset base. So when we're coming in providing additional capital, it is not so challenging to meet the 70% test because the older asset base tends to be smaller. Obviously Karen had a set of very significant tangible assets, and she had to navigate that, which made it a bit more difficult. I have not seen a lot of activity on the larger side of the spectrum for transactions with the Opportunity Zone framework. I think it works really, really well for what we're trying to do. It's a bit trickier, as we mentioned, when you have greater historical assets. And, that's something that legislators may want to think about on a go-forward basis, whether there's a way to make this more navigable for businesses that have a heavier asset base. Really, when you're coming in and providing new capital for growth, you want that in an opportunity zone. Obviously, it's good when a business is attracting capital, because that leads to additional jobs and economic opportunity, and that's really the thrust of the program. So it would be interesting to see, some additional solutions on that front for businesses that have, greater existing assets.
Jay, one follow-up, because this came up in our prep call. Are you seeing or not kind of businesses that are mixed in with real estate developments or investments, or and in particular, I know we have a lot of folks on the call who often are doing a development that is, perhaps multifamily housing plus retail for a business they have in mind, or something like that. Have you seen a lot of examples like that, or
I've seen a couple of examples of, and this is sort of more in my universe of areas creating startup accelerators in an opportunity zone, which I think makes a ton of sense. So you have sort of a building that can receive tax benefits, and then you're attracting sort of earlier stage companies within the context of that building. And I think that's great. Where I would love to see more appetite is among the real estate investors themselves to carve off a portion of their investment capital to think about operating businesses within the context of their developments. Because obviously building a business is one thing, but you need to have, activity within that geography to populate the building. So, I've seen a couple examples of this. I would love to see more where there's a larger real estate project and there's enough forward thought within that real estate project where there's a sidecar to invest in operating businesses that would be, future tenants for those facilities on a go-forward basis.
Karen, I want to come back to you. I mentioned that Rich developed his own Opportunity Zone fund, and you've already talked about how you went and actually approached funds like Jay. And now that you have actually gone through that process successfully with a funder, could you help the group understand kind of what that process looks like? You got some of the tidbits in there in your last answer, but I think many, especially small business owners on this call, are very familiar with going and getting loans of various sorts.
Right.
But going and getting equity investment is unfamiliar to a lot of this audience. And so just sort of understanding how that process generally works and the expectations that, that funder pool would have of them.
So I think ordinarily the funder, the Opportunity Zone funder would have a term sheet that they usually work with the companies. And I have not actually seen that, because in my case, I had a term sheet. We already had started our Series C investment round. We already were into it 20-30%. And then the Pearl Fund came in and decided to lead the round to close it. And so while we had to adapt to some of their peculiarities and their requirements for reporting and what have you, and they had, there are penalties. I don't know if people understand this, but if an Opportunity Zone fund doesn't keep a certain percentage, I think it's 90% of their funds in their prescribed statements, which is Opportunity Zone qualified Opportunity Zone businesses, then they get penalized. And so then companies like ours would likely need, at least in our case, needed to accept the responsibility for a portion of that. So, that's a little bit of a tricky uniqueness to it. Our term sheet was set and they did not challenge it. We did, and if people are familiar with Series Seed, you know, often it's for preferred stock. And in our case, we offered warrants. We had a difficult time getting investors. And so we issued warrants that were very appetizing. And then, but the really cool thing about Pearl coming in is after they essentially committed, then we were able to secure additional investors, institutional investors. So we were able to get the Center for Innovative Technology, who had already been talking to us, but they, you know, committed and invested significant, I think. And then we had a big additional investor with the Cav Angels. Cav Angels is an angel group in Charlottesville who had been in due diligence with us for a couple of years. We've been talking to them for a couple of years. And with Pearl coming in as a lead and with CIT with them, then the Cav Angels, it was an easier bite at the apple for them. So basically you had to negotiate all the lawyers, which is why it can be very expensive. You know, they have to deal with all the different side letter requirements and that sort of thing. And then issue all the warrants and with the 3 different investors. We also got another investor company, actually. It's trades on the trades. It's a publicly traded, but it's about to get listed on NASDAQ. It used to be a pink sheet. And they invest in early stage companies, and they came in towards the end as well. So the other thing I would mention about process and getting ready, Appalachia Community Capital has sponsored a funding mechanism for people in Appalachia, which is where we are. We're in Southern Appalachia. And they have funded technical assistance grants for people like us who need help in figuring out how we're going to solidify our funding with the Opportunity Zone. Now, we were fortunate. We had made enough progress that we didn't actually have them, we didn't need them, or we'd need them, but not for this round. We are now in that technical assistant process where they're working on a major kind of realignment of our market to make sure that we've got solid market numbers for going to market. And we have good numbers, but they're going to make sure they're really good and do new pro forma cost analysis and revenue analysis and EBITDA, et cetera. And working with our CFO and me, of course. And then they'll be putting together pitch decks and getting us teed up to talk to Opportunity Zone funds. Jay, I might actually have suggest that they talk to you as an interview because they're creating some new materials around this, and they're going to be talking not only to our market folks, but to the investment groups as well. That'll be coming out in the next few months, and then we'll use that to raise our Series A round. And so we'll start teeing that up, you know, in sometime in 2021 in reaching out and making sure that we, of course, make the progress we need to get the sales, et cetera. And then, but use that support. People need support. People need help, especially small businesses. So, and not very many people know what's going on in Opportunity Zones. So they need to go out to the people that are really knowledgeable already and not pay for your experts to become knowledgeable. It's hard. It's hard stuff to learn and understand. Is that good?
It's fantastic. We actually have a really good question from the audience that might be a nice way to segue from some of these early questions was, you know, and it'd be good probably to hear from Rich and Karen specifically kind of what they envision, but then Jay, more generally, what you're seeing is, you know, this program is designed, the big benefit is if you, as an investor, you wait 10 years or more, right? So talk about the exit strategies in these operating businesses, you know, that you are thinking about employing in order to give the investor that chance to really realize the fruits of the incentive. And Jay, you know, kind of, you know, after maybe we hear from Rich and Karen, I'd love to hear sort of like what you're seeing more broadly on this front. Because it is one of the challenges for operating businesses is often the investment horizon is shorter than 10 years, and the exit strategies for a lot of equity investing is, you know, it goes very big and there's a stock offering or something like that. And there's certainly other things in play here. So Richard, Karen, do you want to start? And then we'll end with Jay's thoughts.
I can start here. I think, again, our business will be different than most that probably use the Opportunity Zone funds. A grocery store is a business that will be hopefully existing forever in perpetuity in the community, doing good things, building the local economy. So the preferred stock that our co-op sold to the Opportunity Zone Fund is basically that we will make best efforts to redeem the preferred stock in 10 years. And investors get an annual dividend of 6%. So ours is a little different. The upside is not, the upside is 6% and you get your money back in 10 years. So that's, we went through a similar process to what Karen described in terms of getting all of our financials together, working with outside consultants. We worked with the best people in the food co-op grocery industry to have our pro formas, all of our financials in shape. But at the end of the day, our investors are more social investors who, want a fair return, but they want to do something really great for the community. So I don't know. I hope I answered the question. That's the approach, that we're taking.
I would add on a couple things. You just made me realize I wanted to mention that you have to have pretty formal audits with this work, and they're costly. And early stage companies like ours don't have their financials right, and there's a lot of work that needs to be put into making sure that they are clean. And so that's something you can do in preparation for that kind of investment. And I think we'll be in good shape for Series A. The 10-year horizon. So I'm in my 12th year working on this business, right? I got $7 million behind us. And our post-money valuation was maybe $5 million when you add the convertible notes being converted. My objective is Series A to be at least 2 or maybe 3 or 4 times that value in order to attract the Series A. We have the potential to do that because of the traction we have with a couple of different markets. So if we're able to do that, and then within the 2 or 3 years after that, the company very well may sell. Guess what? Pearl Fund gets their money back. They make their money. They get their 10x. The Opportunity Zone Fund itself has to have their investments in for the 10 years. But the individual companies, I don't have to be around in 10 years. I could have been bought by a Suez or a Veolia or what have you along the way. But as long as they get their money back and satisfy their investors, then they're not going to have any trouble from the feds or their investors. I believe I have that right, but Jay, I'll leave it to you to correct me if I'm wrong.
So we are looking for companies that can grow and expand over a 10-year horizon. That's what, when we go in, we'd like to find businesses that have the ability to scale over that time frame. It is much better for us if we hold that investment for a 10-year period. If there is an early exit, we can deal with that. Basically, the gain that was realized early, we actually have to pay taxes on. But the holding period for our investors would continue. So they would get the credit for those years that they were already in the fund, but they would have a tax bill if a company sold early. And we forgot to make this disclosure at the beginning of the call. I am not a tax expert. I am not a lawyer. This is my understanding, so take it with a grain of salt. And this is all a area that is formulating rapidly, so verify. But my understanding is we have, if we get an early exit, a 12-month period to reinvest that in another qualified Opportunity Zone business that would allow our investors to continue to stay in the fund for a longer period of time. So that first investment that exited early, we would have to pay the capital gains on, but what we reinvested it in If we had held cumulatively for 10 years, we would be exempt. So there might be, a combination where you held something for 4 years, you paid the taxes on that. You held something else for 6 years, then you get the exemption on the second one.
Wow, I just learned something.
So there's actually two things at the outset that I should have said. One is, and this is in all seriousness, this group is not a group of lawyers and tax accountants. And so we're sharing with you our experiences. As I've sort of alluded to, I highly recommend everyone as they go and embark on this to leverage both forms of counsel, legal and tax for sure. The other thing that I forgot to mention is, our assumption in this call is a lot of folks have some familiarity with the program and even some of the technical experience with it. I know we've gotten a few questions that are in that vein, and please keep the questions coming and we'll answer them as we can. But also after this call, we'll give you the contact information at Opportunity Virginia, and that's something we can also help with some longer conversations because the fact sets are pretty important. Jay, I do want to go back to you. We've heard a little bit about return expectations, and we just talked a little bit about how to get to the liquidity event. These are, this program works for all different sectors, all different types of businesses, and all different types of stages. But the belief was, sort of the philosophy of the law is that the investors or the business or could theoretically offer a smaller return because they're providing impact in the community in the forms of economic growth, et cetera, and or the investor itself is getting a benefit on the tax side. As you look across kind of the larger landscape, are you in fact seeing a discount in those returns at all? If so, what does that look like, and what has to come together for that to be a reality?
Yeah, so I would say from a business standpoint, qualified opportunity zone business, I think the program is a great way to get attention to your project. So, you have funds like ourselves who are specifically seeking out opportunity zone deals, and organizations like yours, Adam, that are making these great pairings. We are still a seed fund. We still have investors who expect similar returns to a seed fund. The opportunity zone benefit is helpful from a after-tax return standpoint, but only if you make money, right? So a loss is still going to be a loss. So in that context, we are taking substantial risk in early stage companies, and we underwrite our deals at sort of similar return levels. Often we're coming in with another taxable investor too. So, that's all driven within the context of the overall deal. As a early stage investor, we have a much higher return threshold than Rich's project, for example, where it was sort of a much lower risk return coupled with a community benefit. So long and short of it is, opportunity zone legislation doesn't make a bad deal a good one. It's a great way to get attention for your project, and it's a great way to attract additional capital. So you may be able to upsize your round and potentially get a little bit better terms, but the deal still has to stand on its own merits. And I think that's a good thing. Like, you don't want legislation that's encouraging, waste of capital and bad investment opportunities. These are good deals in places that they may have had a much harder time attracting capital prior to this legislation, so they get attention and additional funding opportunities.
So one vein that I'd like to go into before I reopen it for questions here in a couple minutes, and I'll start with you, Karen, which is, again, this law was designed to get into low-income communities, not just in certain settings in the country, but in very urban settings as well as very rural settings, right? And again, I think the rural examples thus far have been fewer. And I'm curious, from your perspective, do you think there were any unique challenges because of your location? You touched on that a bit, that in some ways getting out of DC may have been a blessing, but were there any, was it harder to get attention, or curious what you would relay to folks that are in the not in one of the 4 or 5 larger cities in Virginia?
So if you're speaking about traditional investment, it wasn't going to happen. It just wasn't going to happen. It just wasn't going to happen. I mean, that's why I went after grants and continued to go after grants and a cooperative agreement with the EPA to validate our technology, and attracting the university professors to do ad hoc studies or pro bono studies to validate. So I did a lot of validation, and so once we did get the bead on opportunity zones, we had all this validation, we had a customer and all that. So I'm not sure what I would have done had the opportunity zone opportunity had not come up. I don't know that we ever would have gotten investment. And I know what we would have had to do is organically grow, get grants, get customers, 1 off, 2 off, and it might take another 10 years. And then Jay, I'd be able to be around for 10 years. But the opportunity zone was the right gig for us. And I think, and the other, to be honest with you, I mean, I'm a woman-owned business. I was a woman-owned business until a month ago. And that's the girl in the room, right? Less than 3% venture capitalists invest in women-owned businesses. Now, there's a lot of people that are trying to make that change, but it has not changed culturally yet. And so when I would pitch people, I'm a woman first, sorry, the technology is second. I mean, it's just the way it is. People don't recognize the bias that endemically we have with, well, we do realize the bias we have. So now that I have the Pearl Fund, now that I have Cav Angels, now that I have this keto group and also CIT, I think that's going to be less of an issue because I've got validated investors and that sort of thing. But the other thing is that there's been a tide change. The first 5-6 years when this is kind of interesting, when I was building the company, and I have $750,000 in the company myself. I mean, that's just the way it is. I had to keep putting money in myself. But it used to be that being a woman-owned business was sort of a hindrance, but now it turns out I understand that LPs, limited partnerships, as they're putting money into these funds, are looking at diversity in their portfolio as a criteria around investment. And I've heard that from a couple of different angles. So now it may not be as much of a deterrent from obvious preference on the part of VCs. But I certainly haven't had that issue at all now.
Jay, given this
less than 1% of venture capital goes to rural areas, so you're sort of swimming against the stream in a lot of ways. We're trying to change that in a small way, and hoping that there's a lot of macro trends within the country that with the pandemic, remote working has gotten a lot more accepted. We're on a Zoom call now. I think there'll be a proliferation of existing talent into these areas that may help in many ways to encourage investment in areas that haven't seen it historically. And we'll do our part.
Can I mention one other thing, that since I've been doing all of my work Zoom, I haven't had to be in a car going across the state or going to another state and traveling 6 hours. So people, when they see you on a Zoom call, they don't know you're in rural America, right? And then they won't come to see you necessarily there, but you can participate via, virtually. So I think that's going to have a rather significant impact, frankly. We certainly, during COVID, we did better because of that. So actually, it's really strange, but I think the rural investment opportunity, both sides, is going to increase because of Zoom and the like. There was another point I was going to make, and I forgot what it was.
Well, if you think it up, I'll bring it back. Okay. Jay, this word's been brought up a number of times, or this phrase, a pitch deck, in the importance of, and just the process of actually pitching your investment to a group of equity investors or just an equity investor. You're on the receiving end of that a lot, right? Folks are approaching you and trying to get you to invest in their business. From an opportunity zone perspective, what is, when you look at one of those or have one of those meetings, like what signals to you that, folks really know what they're doing, that it really is an opportunity zone or has opportunity zone potential? And then what signals to you that, potentially that I'm not sure they really have figured it out, just so folks know how to really prepare for what is a pretty pivotal bit of information and event.
Yeah, so for us, the far more important piece of the deck is the merits of the deal outside of the opportunity zone aspects. So do you really know your industry extremely well? Do you have a great idea to solve a real problem? And do you have some type of competitive moat or advantage that's going to be sustainable over time? So on the opportunity zone side, there are certain asset-heavy businesses that are going to send a red flag for us if they're sort of older asset-heavy businesses. Otherwise, we're happy to work with the companies on ways to structure themselves to fit within the opportunity zone constraints. And they're really, for many businesses we deal with, they're really not that challenging. If you're asset light and on the younger side, it doesn't have to be that complicated. This is I know Karen had a lot of difficulties, but for a lot of businesses, you can do this on a relatively small scale and make it work. There's no sort of minimum size where this is no longer viable. So I would encourage people to investigate it even for smaller transactions.
All right. Well, we're running out of time, and I did I prepped these three great panelists for one last question, which is essentially, what last bit of guidance would they give you as folks who potentially take on this opportunity zone incentive? As an entrepreneur or a business that exists today that feels like they could use the program, or in another version of this question is, what do you wish you knew before you got involved that you know today? What's kind of the parting words of wisdom, if you will? Rich, why don't we start with you?
Okay, thanks. I think I would echo what Jay said. I think the most important thing is to have a solid business proposition. Really make sure you've got all your ducks in a row in terms of what you're planning to do, all the support for why someone should invest in it. And then I do think the opportunity zone mechanism does open up, it allows you to talk to more investors than you otherwise might be talking to. And we had a lot of investors we talked with about opportunity zones, and they ended up investing in us, but not through the OZ mechanism. Some invested in the OZ mechanism, others invested in other ways, but the OZ mechanism was the door that led us to those investors. So that was great. The other point I would make is, figure out who your targeted investors are. Who would like to invest in your business? It was interesting listening to Karen with the Pearl Fund, but step back and look at, try to identify a list of investors. And again, Opportunity Virginia was very helpful, and we actually went through a list of investors to contact together. Some that we generated in our community, some that Adam, generated. We sent them emails, we called them. We had a group of people calling potential investors, but there's, this is all about finding the investor that wants to put money in your project and having the value proposition that works for that investor. That's my best advice.
Thanks, Rich. Karen?
Am I on mute or unmute?
No, you're unmuted.
All right. So what I've learned from me is that from the standpoint of attracting investors to me, to this company, and there's many books written about stick-to-itiveness, perseverance, never give up, the grit to stay the course, all of those things. And as I talk to people over the last 3 years, I don't give up if they say no the first time. I come back in 6 or 8 months, we've made a pivot, when we've made a progress. And so what I've learned for me, for woman-owned business, could have been different if I wasn't, is that I needed to establish credibility repeatedly over a long period of time. And there are several people who I recently readdressed for the Series Seed that are very excited about the company because of the progress that we've made. And they very much want to be, us to be considering them for Series A in a year or whenever. So don't expect the first time you brief someone to say yes. They're just not going to do it. They want to get to know you, and it's harder now without Zoom. They want to understand who you are as a person, as a leader, as a manager, and they're not going to dive into due diligence and make a major play for you, right off the bat. Now, if you get referred by Jay Beekman, you might, which has happened to us. And I very much hope that those kinds of things happen. But in truth, I think for example, Jay, I went through due diligence with him last year, no harm, no foul. We were too early. I'm going to be back on his doorstep next time, right? And I'll continue to stay in touch with him and others. There's a seed fund in Virginia Tech area, and we've got traction with them, and we'll continue to work with them. So just can't expect it overnight. And the other thing I would say is that I would hope that Opportunity Virginia will continue to mature their ability to help the small businesses out there. They have done a phenomenal job jumping in, taking a leadership position. I don't know if other states are doing this. I have some ideas that might help you in how you might apply your resources. And there are some lessons about relying on experts and getting advice from people that may or may not be. And so I think that you have a very major role to help us in the future. And thank you for what you've done so far.
Yeah, I think this program is sort of self-monitored and simple to a certain extent. So it's easy to get your arms around it to start. So I would say start with the available resources and work with that and understand if your project is within sort of the scope. But as you get down this road, there are great resources available, both at the state level and federal level to guide around opportunity zones. So take advantage of them and just network as much as possible for these projects, because it's not a massive universe of opportunity zone funds. And having that sort of guidance through available resources, I think, can be very beneficial as you try to navigate the best areas to seek capital.
Thank you, Jay. Thank you, Karen. Thank you, Rich. Really appreciate your time and insights. I think I speak for all of the audience here when I say that. I'm going to end this on time with just a couple quick notes. One is feel free to reach out to us at Opportunity Virginia with any additional questions. I know Valerie provided the contact info in the chat, but we're a pretty easy Google search away. There's actually this workshop is the second in a 4-part series. So check that out on the website too. There's one tomorrow and there's one next week that might be of interest to folks. The last thing I'll say is the Economic Innovation Group has also done a few series in a similar vein, a webinar series that they've recorded and provided information for on successes in the in the operating business space and the opportunity zones. And so that's another resource for folks to check out too. And we'll be happy to point folks directly to that too. Let us know. Have a great afternoon, everyone. Stay healthy, and I'm sure we'll be in touch.